Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. Will Thomson of Massif Capital comes back for his now yearly appearance on the Business Brew. We talk lithium, we talk copper, and I like the whole conversation, but my favorite part is probably these last 20 minutes. He and I get riffing, and sometimes I think that's where the most gold comes out. But I do think that the beginning of the discussion's quite interesting. And we talk about the Lundin family when we touch on copper, and I think that's very interesting. So hope you enjoy the episode. As always, thanks for listening. And you know the disclaimers, which I believe you will hear in just a second after this sponsor read. Thanks to Daloopa. This episode is sponsored by Daloopa. Daloopa is founded by a former hedge fund analyst to bring simplicity into the investment process. Daloopa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. Daloopa scales the velocity of an investment team's idea generation. Analysts spend less time locating and manually inputting meaningful disclosures into Excel and more time synthesizing in the minutes after the print. Daloopa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Daloopa's data sheets include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Daloopa's Excel plugin can also update your existing models for the latest quarter in just a single click. Bulge bracket banks and major multi-managers are trusting Daloopa for their use in initiating coverage, building and maintaining industry dashboards, and keeping their models up to date. Visit daloopa.com/businessbrew to create a free account and learn more about how Daloopa can increase your team's speed to differentiated insight. As always, nothing in the show is financial advice. Please consult an investment advisor before making investment decisions. Everything in the show is for entertainment purposes and educational purposes, and do your own due diligence. Ladies and gentlemen, Will Thomson back for the third time. Is this the third time? Is it 3 years? I guess.
Yeah, I think once a year for the last 2 years. So this will be the third, yeah.
That's exciting. Both of us have survived 3 years. That's a positive.
A tough 3 years.
Yeah. Well, it's a good thing nothing happened in those 3 years, right? It's not like we had a global pandemic and then came back from it or anything like that.
Yeah, we've all just been hanging out in our houses doing nothing.
Yeah, it's been interesting. What's your general vibes on the market right now? What's going on out there? Because it seems like we're in the middle of a quality melt up. It seems like some of the more speculative or further out duration cash flows are getting bid again, but I'm not sure if I'm seeing it like you're seeing it. So I'm curious to hear what your eyes see.
Quality melt up. What do you mean by that?
I mean, Costco's at like 40 times earnings, which I know earnings is an antiquated thing, but it's just like, I don't know. It kind of feels like we're back to where we were.
Yeah, maybe a little bit. I definitely feel like that with the parts of the world that I traffic in. So, industrials, energy, definitely mining. Nobody wants to touch a mining firm right now. I guess gold caught a little bit of a bid at the end of last year, or people got a little excited about it in conversations with people because it was brutally washed out, I guess, if you will, while the price remained sort of relatively high.
So you're saying the miners were brutally washed out while the price was still moderately high?
Yeah, no, I mean, nobody wanted to touch them. I shouldn't say they're washed out. It's not like the stock prices collapsed or anything, but in like epic proportion. But, nobody wanted to touch them. And you go to some of these conferences, and usually you go to a junior mining conference, and you're like, I run a hedge fund. And they're like, oh, well, here's a line out the door of junior miners who would love to talk with you, because they're all looking for investors. And this last year it was pretty empty, pretty quiet. You get these hallways where they got little tables, right? You want people to have little conversations, and those hallways were empty. I know that trying to finance mining right now, just talking to the banks up in Toronto and looking at sort of deal flow. Like I get a lot of, we're doing a private placement, we want to do a new drill campaign this year, come buy some shares. And you look at sort of the fees that the bankers are taking, and, I've seen just sort of compression, right? Because they're all like fighting and there's no money out there. So it's hard to finance a mine. And, you look at oil stuff trading sideways, not a lot of interest. I mean, oil prices are trading sideways too. So nobody's got any interest in anything that I look at. I guess though, yeah.
Why is
there's
that?
definitely a bifurcation.
I mean, are we going through like, did the miners go through this period of overexpansion and they're just not, they've underperformed, or is it just like people are not interested in the sector?
I think it's a combination of things. There's definitely a China element to it, with everyone just sort of concerned about China, and, rightfully so. And China obviously consumes, massive amounts of all materials, a lot of which then gets exported back out to the rest of us. But nevertheless, they are themselves a large consumer. So I think there's the China story. There's still, general recession concern from everyone about, wherever you are. I'm not sure where, I think that the soft landing story in the United States has definitely picked up steam and, continues to be there, and the cutting rates and all that good stuff.
Oh, I think that's consensus.
There's still,
isn't that consensus now? The soft landing?
Well, absolutely. But I'm not sure it's consensus enough that people are like, yes, let's go with, cyclical mining firms and industrial companies yet. They're, they go industry by industry, and right now we're back to maybe, consumer, what would Costco be considered? Consumer staples or something?
I would put it in the staple category.
Yeah. So we've gotten there, but we're not confident enough in the soft landing to go to, copper growth stocks or something.
Yeah. Yeah, the industrial names that I follow have definitely, they kind of ramped into the end of last year, and then they've sold off a lot.
Yeah. They all our money this year, 4 weeks into it, has been made on the short side. So the long side is just not doing anything. So outside of uranium. But I guess if I actually look, probably most of our returns in uranium came last year.
Uranium, the most beautiful shortage that ever existed, if it works to the upside, right?
Yeah, I guess I'd have to think about that, but it's definitely a shortage, and it's one of those. What's the old saying about going bankrupt? Slowly and then all at once.
Yeah,
that's been the uranium story for 10 years, which is why it's been tricky, right? It's been there's a shortage. It's building, and maybe this year, maybe next year, maybe the year after is the all at once. But we're going to have to see.
Yeah, well, when we had talked, what the big overhang was the Russian decommissioning of nukes. Is that true? Or there was some like Russian supply that you said, leaked out over time and made it hard. Has that changed with the Russia situation?
My understanding is it has, but I also think that program, I don't remember what it was called, but I think that program also sort of ran its course, if you will. And I don't remember when it ran its course, but there was a big overhang of supply as a result of various government efforts at denuclearization, if you will, or something.
Yeah.
And that highly enriched uranium produces a lot of low enriched uranium. So,
yeah. Well, I couldn't help but notice that your letter was about lithium primarily. You want to talk a little bit about lithium and the narrative around the EVs that may or may not be correct?
Yeah, sure. Massif Capital's sort of investments or journey with lithium. I mean, it started, our first year of operation was 2016. We avoided lithium for a while and just sort of watched on the sidelines. We made an investment in Lithium Americas in 2020 in March, when we were all sitting at home doing nothing, and been sort of investors off and on since then. What's happened recently is that lithium sort of shot the moon in 2021, 2022, got up to, and spot prices are a little difficult with lithium because it's mostly a contracted market, but a spot price does exist. But it all sort of correlates to China activity. Spot prices got to $80,000 a ton for lithium carbonate equivalent, which is how it's usually quoted. Two types of lithium go into batteries, hydroxide and carbonate. Carbonate is more common. And then, of course, when it shoots the moon, and I don't remember what the percentage change was, but, it's a couple 100%, went up a couple 100% on a lot of EV demand growth, concerns about supply going forward, a lot of struggles with existing producers to add to capacity. And then, of course, it did what commodities always do, and it collapsed in sort of somewhat epic proportion, falling from the $80,000 a ton or something to, what do I got now? I got probably like $17,000 a ton in China, roughly speaking. And that's occurred over the last, let's call it 12 to 16 months. While that has occurred, of course, you've got this EV narrative about slowing demand, and then you've got a couple of other market narratives about increasing supply out of some funky places like China and Africa, where, at least from my perspective, and I wrote about in the letter, you've got to have a lot of faith in some very sketchy sort of operations and things like that to think that supply is going to be there. And so now we're sitting here with lithium at a price where nobody can bring on a new mine. And yet the demand remains fairly robust. And while people have talked about, a slowdown in EVs, they still grew at 50% last year. And they're still growing at rapid rates in Europe, and they're still growing at rapid rates in China. And so, meeting the demand from even that slower growth, 50% slower, requires, significant new mine additions. And those mines, like any other mine, take forever to bring online. And then, of course, you have to bring online the processing capability, which is really tricky. And that's where we have very few experts and very few companies that are capable of doing it. And so the setup for lithium looks like sort of a narrative on the front page of the paper about EVs not selling, which is really just a story about them not selling as quickly. And on the supply side, there are expectations from sell-side desks that there's going to be, significant growth in supply coming out of China and coming out of Africa. And both of those are sort of dubious stories built on sort of pretty optimistic expectations about what are these really poor, really weak deposits in China that come from a mineral called lepidolite, and these sort of Herculean logistical efforts for mines in Africa. Nothing runs smoothly in Africa either. So if you think it's going to come online in 2024, it's going to be 2025 or 2026. So there's just there's these two narratives coming from both sides, demand and supply, that they don't appear to necessarily hold up.
Yeah. Do you think, so I'm going to give the sponsor of the show, Daloopa, looked it up in real time here. Tesla deliveries look like 2023. It looks like 1.8 million. My units may be off, but that sounds right. Can't be a billion cars. Up from 936,000 in 2021. So to your point, that's almost doubling deliveries. But if you listen to Elon talk on the calls, he's talking about how difficult it's going to be. He's talking about how cost improvements are not going to be able to catch up with the additional interest costs that people are paying. So I just kind of wonder how much people are listening to what is said versus looking at the actual numbers. And I think the other thing that's kind of papering the headlines is you see these car companies maybe arguing that the EV production, I want to say it's being painted as uneconomic. Maybe reality is it's not quite as economic as they had hoped, as quickly as they hoped. So they're maybe scaling back ambitions. But to your point, when you look at actual units coming out It's not as if there's not some catastrophe here, I don't believe, especially when you think about interest rates going as high as they have gone.
Yeah. I think, though, there's also an issue with, and this is a U.S. thing, right? We live in the United States. It's Tesla, it's Ford, it's GM, it's Stellantis, right? Those are the guys we focus on when we think about cars. But of course, there's a whole mess of other car companies and a lot of car companies in China consuming and growing their supply or their production quite dramatically. And you have companies like BYD who are ramping production and selling these cheap EVs to the rest of the world. And they're not being sold in the United States, but to the rest of the world, they're selling them. And by focusing solely on, say, Tesla and the legacy automakers, you're missing a big part of the story, I think, in terms of EV ramp up, specifically the part that's occurring overseas, which, again, look, the United States is a huge auto market, but it's not the only auto market.
Yeah. It's very easy to get myopically focused on the US.
And then you've got, I think the story with the legacy guys, and I don't think they'll all survive personally, although maybe the government comes in and bails them out. But they're just, they're slowing it down a little bit. And what I think is more interesting than saying, oh, how do we get to 100% EVs is looking at the other scenarios where, what does lithium demand look like if we don't get to 100% EVs? Because that seems much more realistic. Like, I don't know what percentage of EVs we end up with as a percentage of new car sales, but EVs are not fit for every driving purpose, right? They're just not, you live in rural United States and EVs probably not great. There was a Doomberg article about a guy up in Alaska recently. Okay, if you live in Alaska, an EV is probably not really
that's not your thing.
But so we don't need 100% EVs. We don't need these guys to go to 100% EV sales in order for lithium demand to grow quite dramatically. When you look at the mine supply that's coming online and how much volume is needed, there's a real disconnect between what is coming online and what is a reasonable expectation. If EVs in the United States double from here, and that still puts them only at, that would put them at, 18% of new car sales or something along those lines, less than 20%. You're still consuming all the lithium from a mine that has yet to be built in Nevada. And so where is it going to come from if that mine doesn't get built? Well, I don't know where it comes from. So there's still a disconnect between slower growth and lithium demand, let alone, these guys accomplishing what their goals were a couple of years ago. And admittedly, those goals from a couple of years ago might have been outlandish, and I certainly think they were. But that doesn't change the facts on the ground with how hard it is to get a mine up and running, how hard it is to get the lithium processed, and then get it into a battery for a case where, again, demand only doubles from here.
Yeah. Well, we're going to level set here and give people some facts, and this is straight out of your letter. The average American drives less than 40 miles a day. Seems like 300 miles of range is significant relative to 40. Then you go on to say many EVs are too expensive is an argument that you hear, but you dismiss, or I shouldn't say dismiss it, you identify it as a red herring. In 2022, the average price of a new car in the U.S. was $47,000. In 2023, it was $49,388. Meanwhile, the average cost of an EV was $53,469 in 2023. So that's 10% difference. I quite enjoy driving an EV. Now, it's not my only car, right? I have a Jeep product that I wish I could, if I could actually dispose of it without costing myself anything. Like if it didn't cost me anything to just burn it, I would love to watch it do that. But that is neither here nor there. But I got this EV loaner when I took my car in, and I was like, crap, this thing is going to kind of suck, and it looks so nerdy. I love driving every minute of it. I was like, man, this thing is wild. What did you say the basis that a car has to compete on is? It was so simple.
I mean, there's a whole larger argument here, just to back up a little bit, about, I think EVs have been sold for a little while on climate change and decarbonization. And that's the wrong basis to sell a car. Who buys a car for that? Well, okay, fine. I'm sure there are some environmentalists out there who buy a car for that reason. But, the car's a tool. It gets you, how, I think I said something in my letter like how efficiently, cost efficiently, safely, and comfortably or something does it get you from point A to point B? And the cost efficient part is a bit of a consumer specific variable, obviously. But on that basis, the EV is relatively fit for purpose for a lot of drivers in the United States. I identified sort of suburban America, where you got lots of parking, you got lots of single family homes to plop your car down in. Okay, rural America, maybe not so much. Cities like New York, probably a nightmare, but most of America actually lives in suburbia. It's probably fit for purpose for that group. And then there was an interesting article actually in The Economist. I think it's this week's Economist. And this sort of is tied up in this, which is, are consumers evaluating the EV on the basis of the terms that they would evaluate a regular car on? And these guys looked at sort of like the political divide. Like who buys EVs, who doesn't buy EVs? And it was a stark political divide. And I think that just indicates that, trying to sell it on these decarbonization sort of thought is just the wrong approach. You're creating a political discussion around a product that has a good fit and good purpose within sort of a specific use case, but it's got nothing to do with politics. So.
Yeah, I wonder too whether or not you were to poll. I mean, this is probably an age issue, but I wonder whether or not Republicans tend to have a little bit more of a affinity to like the muscle car era on average. And I don't know. It seems to me that EVs it's funny because it seems to be like a kindling of some political issues that really don't need to be political, right? If you just kind of removed it all and put somebody in a car and said, let's just see which one you like, and you didn't talk about decarbonization and whatnot, it would be interesting to see people make the choice.
Yeah, I mean, as a technology, an internal combustion engines technology is a perfectly fine technology, just not for every use case, but it doesn't need to be.
Yeah.
And even in the case it doesn't need to be, we still need more lithium. So, that's the lithium story in addition to the sort of supply challenges.
So are you comfortable, and feel free saying no, but are you comfortable opining on what's going on in China? I don't fully understand it. I see Kyle Bass coming out and saying it's the global financial crisis part 2, but over there. I don't know how real that is, how not real that is, but, to what extent is China's sort of hangover right now really affecting the overall lithium market? You may have said it earlier. It's the question I have right now.
Well, so I don't speak Mandarin, okay? I am not a China expert. I spend, because Massif Capital and myself invest in commodity companies, primarily what we call liquid real asset businesses. I do spend a fair amount of time studying China, and I'm going to tell you what I know and what I don't know, and you guys take it for what it's worth. My understanding is that, first of all, the CCP, the Chinese Communist Party, is sort of sitting behind everything at this point. There have been a couple of good books recently about Xi and about how he's changed the system a little bit and centralized it more, and those things all do appear to be the case. So they've increased centralization, the willingness of businesses to go off and do things without getting approval from the CCP has diminished. So, you've had a reversion or rollback of the freedom for whatever it was that is available. Okay. In that process, the geopolitical and geoeconomic goals of the CCP have overtaken some of the profit maximization goals, let's say, of the businesses. And what has happened in the case of other metals, and I'm going to propose that this is perhaps something that is occurring right now, but it's just a theory. In the case of other metals, specifically in the case of iron ore, China has a history of saying, geez, we've got this huge leverage to Australia. And we are really concerned with our independence and the sort of room we have to operate without interference from other countries. And so we don't want to have as much leverage to Australia for our iron ore as we appear to have. So what we're going to do is we're going to roll out a plan to try and grab enough market share and control within iron ore that we are no longer subject to the whims of BHP, Rio Tinto, and the Australian government. And this took the form of them trying to mine a ton of iron ore from the shittiest, crappiest deposits of iron ore that they have. And look, they have iron ore. It's just not very good. Okay? You wouldn't build a mine if you didn't have to, or if the government didn't tell you to. And, that effort failed. They weren't able to sort of gain control of the market for iron ore in the way they were looking to. But what they appear to be doing now with lithium is they appear to be making a really strong effort to push into mining these lepidolite deposits that they've got. And they've got some brine deposits, they have lepidolite, they have some spodumene, and these are sort of let's call these the three big categories of deposits where you can get lithium from these days. And the lepidolite deposits they're the worst of the three. It's tougher to process. You got to mine a ton more rock. And the more rock you've got to mine for the same quantity of lithium carbonate equivalent produced at the end, the more expensive it is, et cetera, et cetera. And what they kind of look like they're doing is whispering around that there's going to be huge growth, there's going to be slowing demand in China, huge growth, and they're quietly going around buying up deposits throughout the rest of the world that are of higher quality, that perhaps once they get enough market share, they can turn down the lepidolite and focus on mining those deposits. And one of the things that's unique about China is that the government sits there and looks at an entire value chain and says, this is the value chain that needs to make money. Any stage in that value chain doesn't need to make money. It's only the whole value chain, which is why you now see them making an effort to push out their EV production into places like Europe. They're looking to try and build factories in Mexico. And, again, look, I don't know this for a fact. Nobody does. I'm not part of the CCP. But the iron ore story is well documented. And I think I linked to a good study of it in my letter. And it does kind of look like they're trying to repeat that. And, control of mineral resources is not new to China. And we see it with the rare earth metals. And they've tried to flex that capability at times in the past. And no reason to think they aren't repeating, something that they've done before.
Does lithium have a market that's deep enough to hedge it in, or is it predominantly just driven by current supply demand and spot prices can be pretty volatile?
So it's primarily a contracted market.
Oh, you had said
futures,
that. I'm sorry, shit.
No.
Okay.
There are futures, and in fact, I got pitched a futures trade on lithium recently. I don't really know the futures market particularly well for lithium. It all is in China, or mostly in China. I don't think, for instance, I don't think the LME has lithium futures yet. Maybe there are some lithium futures in the West somewhere, but it's not going to be very deep, and it's not a big market. It's, a contracted market where, part of the issue is that batteries require, a very specific lithium. It needs to be sort of just right for the chemistry of the cathode and the anode, and all the pieces need to go together because it's a chemical recipe. And so you want to buy, ideally, if you're manufacturing a battery, you want to, much like a refiner of oil, you want to buy the same lithium from the same people that has the same qualities every time, so that when you mix it all in your refinery, if you will, you get the same output every time. And so it's a bit of a hard market to do in spot because, if you buy lepidolite from China and spodumene from Australia and try and mix them together, you may end up
the same
with
grades.
weird.
Yeah.
Yeah. You end up with these weird grades, and they're all looking for 4.9s, if you will. Like things got to be 99.9999% pure in this way or that way. And I think I read somewhere that when they look at batteries and they look at purity, they talk about purity of sort of the anode, the cathode, the electrolyte. You look at and consider parts per billion. If there's 1 part per billion that is some other material, that's where you start to get issues. And so the margins of error on the purity of these things is very small.
Interesting. So typically I've thought about you as like a project level underwriter, but Lithium Americas has been more of a core position for you. What is it about that entity? And I guess it's sister entity or spun off entity, Lithium. It's not Lithium Latin America. I've been looking at Malone entities too much. But anyway, like what is it about that group of companies that you like as a core holding?
Well, so the first purchase was absolutely a project-based purchase, right? We looked at the company. They were turning on Cauchari, which is their Argentinian-based lithium brine deposit. And then they had this thing, Thacker Pass in Nevada, which at the time we bought it, we assigned no value to it. Not because there wasn't an interesting idea there, but just because, it was highly speculative. And to be perfectly frank, there was no need to even assign value to it for the purchase to make sense on the basis of Cauchari alone. At the time, what we really liked about it was, look, brine deposits are really low cost. They're almost always the bottom quartile in terms of cost, which is sort of where you want to be in the cost curve. It's a pretty well understood sort of technology, how to get the lithium out of the brine. And then you had a management team who had a good, strong history in lithium, and specifically in not only the recovery of the lithium, but the chemical processing. And that's a really important step because for all the sort of reasons we talked about before, right? So just mining lithium concentrate, probably not, it's just probably not a great business. You got to get to that chemical bit at the end, which is why all the Australian spodumene guys are trying to get, trying to integrate processing into their efforts. The integrated lithium mine is much more profitable than the lithium concentrate mine with no integrated processing. And so we liked that, the management team. I will admit, we also liked the fact that at the time they were partnered with, and are still partnered with Ganfeng. And, look, whatever you might say about China, they have developed and do understand how to process lithium. And so there's good information exchange, good knowledge to share in standing up that entity. And so the right people on the right piece of land, is in essence what you're looking for in a mining firm. So it was the right people on the right piece of land. We held, it shot the moon to like 35 to 40, which is where we started to sell. Should have just sold the entire position, but I didn't. We all make mistakes. I don't know. I got greedy, so I didn't sell the entire position, but sold some of it. And now, of course, it's collapsed down to the combined entity. What we initially bought in would be worth about $7 now. So our initial purchase was $2, lots of volatility. So we sold options on it all over the place, which was good sort of income generation. And then the company split in two. And the company split in two with Cauchari going into Lithium Argentina. You almost got me there with Latin America.
Yeah, my bad.
Lithium Americas. And Lithium Americas owns Thacker Pass. So Thacker Pass is a US-based lithium deposit that has lithium in clay. And the clay deposits have never been tapped before, if you will. It's just a processing, a flow sheet to get from the extracted, or to get from the mined clay to the lithium chemical that no one had done before, just because there hadn't been demand, right? The brine fed demand before EVs. And so we continue to hold a very small position in Lithium Americas because we like Thacker Pass, but there's plenty of time here for Thacker Pass. They're not going to turn it on until fourth quarter 2026, first quarter 2027. There'll be plenty of opportunity to get bites at the apple, if you will, for a junior lithium producer. Lithium Argentina, on the other hand, has turned on Cauchari and are ramping production as we speak, and it too has sold off quite dramatically. And now is kind of a value play on them being able to execute turning on the operations smoothly. And my expectation would be that they probably do have a problem at some point with turning on the asset. Turning on these big projects is always a problem, but that they probably get there without too much struggle.
Why?
And I put it at something like, I don't know, $13 a share or something.
Do you think that the Argentinian entity, is that selling off because of where it's located geographically, or is it just, to your earlier point, people just aren't really interested in owning lithium miners right now?
It looks like it's all just lithium. Everything's been tossed out. I think if I look at let's see here, if I just look at my lithium, year to date's not a good number, but I don't know. I mean, it's all red. If I look at my watch list for lithium, everything is in a downtrend and everything has sold off by 30% or more over the last 3 months.
It's kind of interesting. Back here in 2023, insiders bought a good amount of shares in October of 2023.
Yeah, well, they were just starting to turn on the mine.
I mean, you're talking 100, that's 3, 4, I mean, 525,000 shares between, this is Lithium Americas, but between 696 and 10. Was that pre-spinoff, or is that like proper corporate entity today? Either way, that's real money.
October, I think the spinoff was October. It was like October 1st, I believe.
Oh, so it would be after that. I mean, that's just something for people to check out, I guess.
Yeah.
It's interesting. Do you feel, do you feel like if I recall correctly, in the past, you said that they issued stock at opportunistic times. Like, they seem, unless my memory is wrong, they seem to be a company that seems to be reasonably decent at capital allocation. Is that accurate?
I think so. They, again, at $40 a share when they were pre-production on 2 mines and $40 a share, they were smarter than I was. And they backed the truck up and offered a bunch of stock. Now, admittedly, there was a good use case for that stock, and that was building out Thacker Pass and some other things like that. So it was going to be redeployed into high return on investment projects, but they were quite opportunistic about that. And then they've made a series of acquisitions when lithium prices have been bombed out. And there's a table, I think, in our letter that sort of compares the cost of lithium in the ground, if you will, that they bought versus what some other guys got. And I think they bought lithium, I think I say something like 60 to 75% below the average of the rest of the acquisitions. And not only did they buy the lithium at these good prices, but they managed to get, it'd be one thing if you were a mining company and you went out and you're in Argentina and you found a good asset in Africa and you bought it in Africa, but that's not what they did. They went out and they found a great project right next to their existing project.
There's actually synergies there,
infrastructure, right? Yeah, there are actual real synergies there.
Yeah.
So I tend to think they're quite good at capital allocation. Now, the team that was in charge of everything at the time of those allocations went to Lithium Americas Thacker Pass, but the senior management for Lithium Argentina is the same people who have been running the assets in Argentina and building the mine down there. So I think there's probably a fair amount of commonality, if you will, in who's in the room making the decisions, even if it wasn't the final person making the decision.
Yeah. Now, part of the way that this all connected, shout out to the homie John and Manual of Ideas. You had brought somebody on stage at Manual of Ideas in December who was a member of the Lundin family, right? I'm saying that correctly?
Yep. Adam.
Do you mind just talking a little bit about who the Lundins are and why you chose to interview Adam and, just kind of to the extent that you remember the conversation, I'd like you to educate people on how he looks at the world and why they're a group of people that you like to be in contact with at a minimum.
Yeah. Well, so the Lundin family is European family. We're on the third generation now. All three generations have been company builders in oil, natural gas, copper, nickel, zinc, you name it, a whole mess of different metals. So energy and mining. Serial sort of entrepreneurs starting multiple companies, multiple mines being built, and have managed to do it quite successfully, repeatedly. And that is quite rare. You find, a geologist can find a deposit, but very rarely can someone find multiple deposits and then build multiple mines, right? The one-time success, that happens. It's the repetition that's really quite hard. And that's probably, that's probably true of any sort of entrepreneurial activity. But the Lundins have demonstrated the ability to do that in what are, usually pretty difficult businesses to do it in. I think I'm going to get the number wrong, but I think Rio Tinto said recently that only, 1 in every 10,000 deposits that are found, mineral deposits that are found actually gets turned into a mine. Probably slightly wrong with the numbers, but, the odds are stacked against you, right? And what I like about the Lundins is that, first of all, they're always the first people to write a check. Okay, so they are always the very first people to write a check, and whenever money is needed, they are always putting in at the minimum enough to keep them at their ownership stake or more. So they're always, stumping up cash, and more importantly, they're always aiming to maintain an ownership stake of anything they do of like 30, 33%, a proper strategic stake. And they're always very cognizant and conscious of the fact that everything they do is highly speculative and exploratory. And so, they are indebted to their shareholders, if you will, who have, stumped up cash to help build these mines and build these projects. And so they're quite grateful for that, and are always thinking about sort of shareholders. And they're always thinking about how they can monetize their assets for the benefit of shareholders, of which they always represent something like a third or something. One, John came to me and said, can you find a speaker for Latticeworks? I thought finding someone in mining would be interesting because people tend to think, mining, cyclical businesses, we're going to bet on the commodity. We'll find some equities to throw in there that have a high sort of correlation to commodity. Copper is going to go up, so we'll buy Freeport-McMoRan, right? That type of thing. I tend to take a different approach and think that there are businesses that you can actually invest in on the basis of, the ideas and thoughts that we all have about businesses. Are they good operators? Is the management team strong? Is there some kind of moat around this asset? There are things like geological moats. Some geologies are unique and result in cost advantages and things of that nature. And the Lundin family has a great track record of building not only assets that seem to have a lot of these geological moats, but they operate them well. They operate them well consistently. They allocate capital across various projects well and consistently. And so these are all sort of the qualities that we look for in management teams for any other business. And the only difference with mining firms is that there are just a lot fewer management teams that do that. And the Lundins are one of them. So.
And the way that they talked about it, you said it's Adam, right?
Adam.
Yeah, the way Adam talked about sort of his family and how he thinks about outside shareholders. I found myself being like, man, this is somebody that, to the extent that vibes matter. I was like, man, this is a guy that I could totally see myself like actually partnering with. And the woman that you brought that sits on your board, she was telling me a story of how they had sold an asset to an operator, and like even though they got the better end of the deal on the sale, the way that they went about it and their reputation in the industry gave them the first look at rebuying the asset, and they ended up buying the asset later at a much lower price. But it wasn't as if no one felt as if they screwed anybody on either side of the transaction. It was just like, these people are just very legit, and sometimes this is how deals go, right? And I thought that was really interesting.
No, I think that, they've got a lot of transactions in their track record. And I think if you go to the Lundin Group website, they go through a lot of case studies. They have a document, like a year-end review type of thing, that reviews a bunch of historical cases. And they do things like, let's say, I know that at various points they've raised capital for X, Y, and Z project and it's gone wrong, and they've reached out to the big shareholders and sent letters out to all the shareholders and said, look, this went wrong. Okay, but we're going to find something else to put in this. And so, we didn't make money this time for you, but if you stick with us, we will find something else to put into this, into this company. And, we'll make money on that. And if we don't that time, we'll try it again next time. And so, they're always thinking about their shareholders. And I think that's a real, and as a management team that owns 30% or so of most of the companies they're invested in, they should be. But that's a real rarity, that combination, being that concerned about shareholders and that large an owner, especially in businesses like mining. So they also tend to look at capital allocation, it seems like to me, they don't look at it, it seems to me, the way a lot of corporate businesses, entities end up looking at it. So they'll go and they'll do something like they went into Ecuador and they bought this just disaster of an asset from, I think it was Kinross, I don't remember, called Fuerte del Norte, which was a gold deposit. And just nobody could get it. Kinross or whoever owned it, and I'm blanking on who owned it exactly, but they just couldn't get the project up and running. And so it was kind of like a cigar butt. They had invested like $1 billion in it, and they just couldn't get it to work. And they ended up selling it to the Lundins, let's call it for $200 million. I got the numbers wrong, but it was a big ballsy capital allocation decision that, again, they stumped up and wrote the first check that a lot of corporate entities, I just don't think would make, because it wouldn't make it through the sort of institutional barriers. And I find that sort of capital allocation, the willingness to put it on the line like that, I find that quite appealing and quite attractive, especially when you're putting up money as well.
Yeah, that's what I liked about them, or my perception of what I heard from him, and what I think is unique potentially. I mean, I need to look, but I think it's improbable that mining stocks are low beta. I mean, I think they're almost certainly high beta, right? So I do think it's an area where a management team might be able to have an outsized impact long term if they can think strategically and rationally about capital allocation. And it was very apparent that Adam was an owner, and he was not like he didn't come across as like this polished professional manager. He came across as someone that took making money seriously. And yes, he's polished, but like, he's a businessman.
Again, on their website, they have this somewhere, but if you just bought shares in every Lundin company starting like maybe 2000, okay, so 20 years, you would have compounded at a higher rate than the S&P over that 20-year period. So, they do appear to have an edge in running businesses that generate good cash flow. and get recognized by the market as being good operators and good businesses to participate in and capitalize on their situations.
So one of the things he talked about was the sort of strategic pivot, at least on a money-weighted basis, to copper. Do you mind going into detail a little bit about what you think they see there or what might be intriguing about the copper market?
So look, they had a big, and I don't know the order of these things exactly from their perspective, right? But they've had a couple of big liquidity events recently where they've sold some businesses. They're sitting on a pile of cash, and they've been studying some of these copper deposits that they've had in what's called the Vicuña district in Argentina and Chile. And they've had these deposits forever, and they continue to explore them. And, a copper deposit, I don't know, you explore it for 10 years and then you take 10 years to build it. So it's like a 20-year project, right? I think the average timeline is 14, but, give or take. And what they've ended up doing is they've exited some of their oil and natural gas projects, and they've reoriented a lot of their focus on Lundin Mining, which is their industrial and base metals mining company, and then a couple of junior miners, specifically NGEX and Filio Mining, which are focused on copper deposits in the Vicuña district. Now, Lundin, NGX, and Filio together basically own this sort of entire land package within the Vicuña district. And what they're finding there are, I think the average grade of a copper deposit right now is, it's less than 1%. It's been going down for, 17 years or something. What they're finding are just massive high-grade copper deposits. They'll be big, big mines. These are mines that will have lives of 50, 60, 70 years and will be, they could be longer than that.
I know, that's just crazy,
copper
man. That's a long life. That's a long time.
The cash flow is way out there in the future. They become hard to value because those cash flows, way off in the future, on a discount basis, they have no value.
Yeah, that's right. They're not worth that much.
You can't really say that, they're not worth this. So they have these huge, sort of deposits that they've found. And I think, look, the argument for copper at a very high level is, look, you have declining ore grades and increasing capital intensity. So as I said, the global average copper ore grade has declined by 75% or something since 1900. Okay, so obviously it's gone way down. And, as that ore grade declines, you're lifting the capital intensity to produce. So the capital intensity has increased from $5,000 a ton to $16,000 a ton, 2000 to now. Okay, then you have sort of this inadequate exploration by other majors and falling rates of sort of discovery. So we're not finding as many copper deposits. And then you have the long lead times. And then on the other side of it, on the demand side, you have geopolitical considerations and sort of inflationary demand impact from, restructuring of global trade. And then, of course, maybe you have this green narrative. And so that's sort of like copper in a nutshell, right? There are all these positive geopolitical or positive macro tailwinds. So you got to find a management team who you want to get in bed with for the long haul, who can find a deposit. You want to get in early, find the deposit, build the asset, and then operate it efficiently. And, you look around and there really just aren't that many people who you'd be comfortable doing that with. Robert Friedland is a guy who started a company called Ivanhoe, another serial sort of mining guy. His company runs an asset in the DRC called Kamoa-Kakula, and they've got some other assets. He's the sort of type of guy you would be willing to partner with. And then you've got the Lundins. And then after that, the cupboard's pretty bare. You've got people who've never built a mine. Okay, copper mines are always going to be huge. So if it's your first mine, it's a big first project. You've got someone like Freeport-McMoRan, or Rio Tinto, but there you're not getting pure, Rio Tinto, you got a whole mess of things going on. You got iron ore, you got copper, you got everything. BHP, again, the same story. So, if you're looking for pure copper exposure, you like the macro thesis, and now you want to find a company with a management team you can have confidence in, there just aren't that many names. So I don't know if that
No,
captured
that
what you
did.
were looking
That
for.
did. That's why that's why I found it so interesting. And when you brought up somebody that, the word that went off in my head was like, this is like a compounder type management team. I was like, oh, now I get why Will has this guy up on stage.
Yeah. No, and I mean, you may need to cycle through a couple of different companies because, they're constantly building new assets, but they're going to compound if you keep putting money in on their projects.
I liked his answer on why they have so many companies too, right? Like why it's not just one hold co. And I thought it made sense. I mean, to my best of my understanding, I'm not looking at notes, but I think he said like it gives investors specific choice into which project to participate in, which ultimately lowers cost of capital. And even though it's maybe a little less efficient from a cost on capital market standpoint, it just makes sense. And I was like, all right, I kind of think I get how this guy looks at the world, but
Yeah, too much diversification, it gets problematic. You end up, you look at someone like Glencore. Glencore never quite seems to trade at what its value might be, and it's because it's all over the place. Or you look at Freeport McMoRan after they bought the oil assets in 2014, 15. It was a copper miner. They bought a bunch of offshore oil and natural gas, and their argument was, well, when copper's down, oil will be good, and when oil's good, copper will be down, and vice. And the market was like, if I want oil, I'll buy oil. If I want copper, I want copper. So I think that argument bears up. You can lump a couple of base metals together as they've done in Lundin mining. They got zinc, they've got some nickel, but it's mostly going to be copper and then some gold byproduct because gold is usually found, or you find a lot of gold with copper usually, but pretty pure play. And then you get someone like Rio Tinto or BHP, and it's really the iron ore, and they're trying to shift in the direction of copper, but it's going to be a long time and a hard road to travel before they get recognized really for, say, their copper production as opposed to their iron ore production.
yeah, that makes sense. So, Will, one of the things I wanted to discuss with you, because you don't see it all the time in letters, is you took your fourth quarter letter was very, I want to say, introspective as to your process. So I feel like I would be doing you a disservice not to allow you to talk about what you think and what you wrote about. So to the extent you want to, talk about it, I'd love to have the conversation. And, people can always reach out to you if they want to know more.
My letters tend to be introspective. I have some people who've said to me, I gotta stop like whipping myself in my letters. What's it called? Like the Catholics, they like wear a hair shirt or something. When I have a win, I'm like, meh, it's a win. When I have losses and stuff, I'm like, okay, I really need to talk a lot about that and struggles. Yeah, I guess in this letter and much of last year, we spent a bunch of time talking about and thinking about our short book. And of course, shorting is just, it is as hard as it gets, at least in my opinion. And it's really got nothing to do with the long side also. Like it's completely different skill set. And so we've had some struggles off and on with it. And, when I first started Massif Capital, it was like alpha only single name shorts. And it proved, there's just not a lot of, in my opinion, just not a lot of great opportunities to get in those types of situations. So we spent a lot of time last year trying to figure out, how do we maintain a short book if we not only can't find enough single name opportunities, but also don't want to be hanging out in those single name opportunities forever. Like that, like time on the long side seems quite helpful,
Yes.
right? In some regards, we're all, sort of engaged in time arbitrage. But on the short side, you get no tax benefit. The markets tend to go up. So you got to find shorts that work and then get in and get out. And, there are guys who find frauds and stuff like that. And I've never found anything that to be perfectly frank, I rarely actually ever think anything is a fraud. I think proper fraud happens so seldomly, and some of these guys who are out there pushing their shorts and they're accusing people of fraud on the basis of like changing language in 10Ks. I'm like,
You want to? Well, one, I interviewed a true fraud. Nafal Sanala was in a Ponzi scheme, but one that never aired. Do you know Pure Cycle?
oh, that was a plastic recycling or something,
Yes,
right?
and still is. Yeah. So
Okay.
I interviewed them right before the 10K dropped, or the 8K dropped, that they had a production facility. I think they had some problem that they had some covenant issues and whatnot. And I interviewed them right before, and then the 8K came out, and we just never got around to like, I don't know. I actually I think they're nice people, right? And like, I think the, it's like the CEO and the hard hat indicator type thing that people say. On the other hand, like the guy that I spoke to is a guy that's trying to operate an organization, and I believe, rightly or wrongly, intends to do well in the world. Now, whether or not he has a technology and an economic model that can do well in the world, I don't know, right? Like, I don't own the stock. I had no interest. I told him, I said, like, look, man, just your capital structure and stuff, this isn't the type of thing that I would own. But I really want it to be not a fraud, and I really want it to work because I think it will be good for the world if it does. I don't know, is it like the in the SPAC, it says the CEO of the SPAC or whatever, his core competence was capital formation. That's not fraud. That's disclosure. That's what the guy did. He put together a SPAC to raise capital for arguably a speculative technology. Like, that to me is execution risk, and is this guy the guy that you want to give money to? But that's not fraud.
Yeah.
So I don't know. Like the line is, I don't know. I
Yeah,
know,
the
and I
line
know
is
some people are
definitely
convinced
wishy-washy.
some people are convinced it's fraud, right? But sometimes that's not. I don't know, man.
Well, I'm invested in a company, and this will send Twitter crazy. I'm invested in Enovix, which is a battery startup, and I mean there was all there was, what was the guy's name? Some guy on Twitter, anonymous. I think his name was Pig Farmer or something like that.
Oh yeah.
It was something quite humorous actually, and he's accused them of fraud right and left, and it's all just these highly sort of speculative, like, and very, like, the starting assumption has got to be that people are bad and that they're looking to take advantage of everyone else. Like, that has to be the starting assumption for a lot of them, because you can't interpret the changes that they see in documents or anything like that. Like, unless you're starting with that assumption, then those changes don't necessarily immediately just lead to fraud.
Yeah.
Maybe I was raised too comfortably or something, but I just can't start from the assumption that people are bad and looking to take advantage of me. Maybe I haven't had enough life experience or something like that. I don't know. But
Well, I think the base rate of humanity would not work if most people were bad and looking to, society would not work right now.
yeah.
In capital markets, especially in some of the smaller stuff, a lot of these companies depend upon raising capital to continue. And to the extent that they depend upon like boiler rooms to raise it, that's totally fucked up. But to the extent that they're like disclosing stuff or promoting the idea behind something when it's still just an idea, like, I don't know, man, that's not really fraud. That I think it's easier to say, you know what? I would require a higher return than maybe the market does to give that money, but that's not necessarily fraud.
No, I don't think it's necessarily fraud. And
Fraud, you're talking like behind bars stuff, right? Like that's a serious term.
And I do think there's also this issue, look, we've had this period of time where like innovation it was all digital, right? It's apps and things like that. And when the apps didn't quite work, a lot of these companies could pivot quite quickly and program something that did work, or, it didn't quite fit the use case that they thought initially, but they were able to pivot and blah, 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 blah. And because they could scale so quickly, you ended up getting out of whatever hole you were in when you figured out whatever it was that your software could be used for and stuff like that. Innovation in the physical world, it's so much slower. There's so many, there's always steps backward before you can move forward. And it just takes so much longer. And so when you start looking at companies, it's capital intensive. It's hard science. I mean, the science behind batteries, there was this great book written last year. I thought it should have been a bestseller, but probably the only person who read it and thought that, called Long Hard Road, which is the story of the making of the lithium ion battery. And it starts in 1965. And you're like, I'm sorry, what? The lithium battery started in 1965 or something like that? And he goes through all the chemistry and, the number of iterations before you got to a final product. I mean, it took until the 1990s. It's hard science. It's on the cutting edge. And so all the innovation that's occurring now in the types of industries that I'm investing in, or in mining, where, you don't see a copper deposit. You gotta trust the management team that it's there. You see the drill results, but, are you a geologist? Most of us aren't. So there's got to be some trust somewhere. Otherwise, you can't invest in that type of thing. So,
no, I think that I like that. The other place that there's been incredible innovation in the real world is semiconductors.
Yeah.
Right. But I mean, look at I think it's a real moat. It's certainly how the market treats it. Look at the perceived moat in those companies because it's so hard to replicate and so capital intensive. That's amazing.
And how many people could actually understand the technology to say that it really is a moat?
Yeah, I can't.
No, I mean, I can't either. You're talking about, I know that company the European company that makes the lithography machines, it's quantum physics.
Yeah.
Yeah, I think it's quantum physics. Did you take quantum physics in college? Well, that one college course in physics was not enough to understand what's going on here. So you're going to have to take their word for it. We all take a lot of people's word for it with the AI stuff. How many of us can explain how a large language model works?
I don't know. That I feel like is some BS. My BS meter is quite high on AI.
Oh, really? Okay.
Yeah, I mean, look.
Do you use it at all?
I use Bard, but it's more than LLM stuff. When this many companies are talking about one thing, I just kind of don't fundamentally trust it. But, I hope it's all real. It'd be great for productivity.
I have found ChatGPT, and specifically this latest iteration, ChatGPT 4, quite useful in figuring out what I need to read and what I don't need to read. So I'll get a large PDF, I got a PDF recently from someone who was a couple 100-page review of the nuclear power industry in 2023. Right. And I'm sort of like, oh, geez, what do I do with this? This is a book. This will take me a while to read this. But if I load it up into ChatGPT and ask it to summarize it, and then I start asking it questions, I find that I can quite quickly sort of say, okay, I don't need to read chapter 1, 2, or 3. There seems like there might be something in chapter 4, and then the rest of it I can skip. Now, maybe I missed, the key variable by doing that. But the other choice would be I would have received it, said, oh, this looks interesting, put it in a file and never turn back and look at it again. So between missing some or getting some, I think, that's there's some gain there.
Yeah, I agree, man. My library would agree as well. I get books and they go on the shelf and they look nice. They're basically art.
Yeah. So, but I guess, this all started with sort of the process discussion, and I guess I don't really have anything terribly insightful to say, but one of the conclusions we came to, again, was that idea that with shorts, at least as we look at them, we got to go with the trend. We got to find companies and industries that are selling off and go with the trend and hit a single or a double and then get out. And, valuation shorting on valuation, like it never works.
Yeah.
We're not finding frauds, so that's off the table. And the value of having a short book is, look, I mean, yes, it does generate alpha, but there's another value, and that value, perfect demonstration of it last year for us. We have our position in LAC. We have our position in both LACs now, LAC Argentina, LAC America. How do we hold that position comfortably while the entire lithium industry gets frickin' smoked?
Yeah, you
Well, we
short
can
the
do
crappy
it
ones.
by shorting some of the crappy ones. And in fact, what we found works really quite nicely is looking at various breadth and market, what John Hussman refers to as market internals, things like breadth and trend and momentum and relative strength and stuff like that, stuff that is, heretical for a value investor, let's say, and then finding the ETF that best captures sort of what the industry is doing and hedging with that ETF. And so last year we shorted Piedmont Lithium as an alpha short because we think the company is nonsense. And we shorted LIT, which is the lithium ETF. And between the two, we managed to hedge our exposure, comfortably hold our LAC position, and fully offset the drawdown in those positions with gains on the short side. And so it came from sort of very much reorienting our perspective and uncomfortably at first, taking a step back from fundamentals and saying, how else do people make money in markets? And how else have they done it sort of consistently? And, when you dig into literature, what you find is that, trend and momentum, the value factor and the momentum factor are these two factors when we talk about sort of factor exposure that seem to work over time. And so how do we, where can we apply that? And factor analysis is quite hard for us to apply on the long side, right? Because I'm sort of I'm picking companies. We've only got, we got 15 in the portfolio right now, and 50% of the portfolio is in the top 5. And I'm sure, I've got some factor software and it tells me that my exposure to the excess volatility factor and some of these other things is through the roof and I should cut the positions and stuff like that. But of course, they're the positions I like for fundamental reasons. So I'm probably not going to do that. So where else can this knowledge be applied? And we found applying it on the short side with sort of an eye towards understanding, what's already moving to the downside and where can we capture a slice and then get out has worked quite nicely. So
here's a terrible idea for you. I wonder if there's a way to get short vol or something and hedge the deltas, which I'm sure you really want to introduce to your process, but that'd be kind of interesting, like if you're long excess vol, I wonder if there's a way to be short vol, but I don't know.
Yeah, I've looked at it. But it's also not the same vol. Like when they talk about factor volatility and you start really digging into the weeds, it's sort of this excess volatility above beta.
Yeah, so said differently, you're in very high beta stocks.
Yeah, I yes and no.
Huh.
Interestingly enough.
Yeah, that's complicated.
We have an extremely low beta, actually, to major indices, and no correlation to anything. Our highest correlation is to the Global Natural Resources, S&P Global Natural Resources Index, and that's a 0.3.
Wow.
So that's our highest correlation of any major index. And we have a low beta and a relatively high alpha. But you can have this excess volatility factor. So I'm not a factor expert, though. So someone could probably come on here and tell me he explained it all wrong because I don't actually understand it.
No, that's interesting. It is wild how the world to some can just be explained by factors. And I think the some have a point in what they're saying, but like everything, there's probably some nuance around the edges.
Yeah. We try to be factor aware.
Yeah.
But I still haven't figured out a way to stitch it all together. I've been pressed to try and think about using factors in my position sizing. And sort of, I don't even know how to explain it because I can never quite wrap my hands around what they're trying to say. So like we take our position sizing approach in the following way. We will, okay, we find our company that we're interested in. We come up with various valuation scenarios. We come up with our expected return, our expected valuation, and we've said, what is the largest position we're willing to tolerate? And for me, it's about 10% at an initial starting point, right? I'm at 10%. Okay. But what does a 10% position need to look like across various different variables? We need to have this much return, dividend, or, whatever, we need to have very high conviction on management team. We got a checklist. And then we say, that's a 10% position. Okay. And so then every position on the long side we say, how does it compare to that? And we size it on a sort of a linear scale, if you will. 10% perfect. This doesn't come quite close. This hits enough of the variables such that we can put on a 5 or a 6% position size. Okay. What I've been told is that I should then take that thought process and start evaluating what the factor exposure looks like and sort of move around that proposed position size with factors. Sort of if I've got too much exposure here, I should lower the size a little bit and adjust it based on what the future return from the factor exposure might look like.
It seems really tough, man.
Yeah, it seems tough. As I said, I haven't.
It seems a little
and I probably haven't even
overthinking.
explained it well.
I don't know what I'm talking about, but it just seems to me like, if you're good at what you do, if I were you and I'm offering the market a product that is not very correlated, I'm investing in sort of project specific is my specialty, but also I have this list of compounder type management teams that most people aren't following. I mean, you're almost by definition going to be tied to some factor given what you do and what your specialty is. And it's kind of like, I think what you're offering is very interesting. So I don't know that I'd mess with it too much.
I would agree with you and to an extent, but where I disagree is, I believe quite strongly that, and I try to convey this sort of in my letters, and I find a lot of letters from hedge fund managers and things like that to be, like, okay, they talk about some ideas, they talk about some wins, and then, they close it out. And I think that we all are actually pretty decent at picking companies, but it's that execution component afterwards and the position sizing, position management that, a lot of us don't spend a lot of time on, where there's like huge room for improvement. Like, I don't know how much more improvement I've got in analyzing a balance sheet.
Yeah.
I'm not sure I can improve much there. So I've got to find places where there is weakness and push to try and improve there.
Yeah.
And one of them, at least for me, is, portfolio construction, entries and exits. I'm terrible at selling. I'm a terrible seller.
I don't know. I want to meet the good seller.
Well, yeah. It's selling.
There's one person out there.
Oh, God, it drives me nuts. It's so hard.
Well,
when you look back, be areas where there's improvement.
Some that you kicked yourself for, and I don't think it's totally fair, but is the holding of Lithium Americas. I mean, at the time that you're saying that you should sell it, what was attractive? I guess the answer, some may say, is energy. And if, I guess I'd be open that I could look back at that and I could say, okay, you could have made a big energy call. But outside of that, man, unless I misremember that time, unless you're willing to go to cash, it wasn't the easiest. It's really easy in hindsight. I think at the time it is very, very difficult to sell some of those things, especially when you believe in management and management is issuing shares. And I am almost certain, I don't have notes on this, but I do not think this is revisionist history, that you and I talked and you said, look, I think the stock's a little rich here, but they're issuing shares, and I agree with that decision. So, it doesn't make sense to me to get fully off this train, right?
Yeah.
And
that
makes sense.
I mean, I think that's I think it's fair. But as I said, I like to try and beat up on some.
Yeah.
There's
Dude, I got out of Charter when it was at 800 and bought Altice, which is terribly shitty, to rebuy Charter to trade that down. That was awful. Everything that I did right in that freaking sector, I ended up undoing. It's very frustrating, very frustrating. But, you live, you learn, you move on.
Yeah. The willingness to go to cash. I think that at the time, actually, I used to have a partner, and my partner's left, and so we're going to be looking for an analyst shortly. If anyone's listening,
I will help you get the word out.
He was very opposed to going to cash. I'm not sure I would have gone to cash either at the time. I'm not blaming him. It's not. I'm the portfolio manager. The buck stops here. But I think that's a legitimate choice. And we'd all probably be better off if we occasionally were willing to make that choice.
Tough business decision, man, because the other side of that is like the allocator. I kind of view that as the allocator's job. So if you're going to go to cash, you kind of maybe have to expect people to redeem, which is tough. But I don't know, man. It's a tough business. It's a way tougher business with way more complicated incentives than just, I'm going to go out and be an investor.
Yeah, I definitely, when I first started, I thought I was like, I'm going to buy good companies, I'm going to publish research, I'm just going to ignore everything else.
Yeah.
And it turns out that was freaking hard and not going to happen.
Yeah, the business side of this, what's the quote? Could turn your friends against you, but that wasn't exactly what I was thinking. Oh, well. Anyway, man, I like you. I like what you do. I like how I think you're very intellectually honest, and it's been a pleasure getting to know you. So I root for you, and I'll help try to get you an analyst.
Okay. I'm going to get a flood of emails. It's going to be ridiculous.
Can't promise you that they're going to be qualified, but I can promise you that you'll get some emails.
Okay. Sounds good.
All right, cool, man.
Well, thanks for having me on again, and I look forward to next year.
Yeah, well, maybe we'll do it before 2025. Who knows?
Yeah. Copper shoots the moon. You can have me back on.
That's right. Or lithium, for that matter.
Or lithium, yeah.
In the meantime, take care of yourself.
Okay, you too.
All right, have a good one.
You too. Bye.